Hello viewers, this is Muhammad Atif and our today's lecture is about variance. This lecture is particularly useful for A-level students, F2 and F5 of ACCA, CMA CAF8 of ICAP and ICMA. Standard costing. A standard is a benchmark measurement of resource usage set in defined condition, and standard costing is a system of accounting based on predetermined cost and revenue per unit, which are used as a benchmark to compare actual performance and therefore provide useful feedback information to management. While the variance analysis is performed by comparing the actual cost and the standard cost to ascertain the difference. Standard cost can be prepared using either absorption costing or marginal costing. General causes of variances. There are some general reasons why the actual results are not the same as standard. First is inappropriate standard. If a standard is set at a level that does not reflect current conditions, then variance will be recorded even if the organization is operating at the required level of efficiency. Second is inaccurate recording of actual cost and revenue. An organization may be operating efficiently, but if costs are recorded inaccurately, then variance will occur. Third is random events. This is said to be unpredictable. The happening of it may cause expected result to differ. Operating inefficiency. If the three causes above can be eliminated, then the variance must be due to operating inefficiency. And improving operating efficiency is the key to stimulating improved performance. Variance analysis. Variance analysis explains the difference between the fixed budget profit and the actual profit in detail. This total profit variance has its sub-classifications. Overall total profit variance comprises of sale variance and cost variance. Further, sale variance is subdivided into sales volume variance and sale price variance, and cost variance subdivided into material variance, labor cost variance, variable and fixed overhead cost variance. In the first category, total material variance, it is subdivided into material price variance and material usage variance, and material usage variance also subdivided into material mix and yield variance. The next variance is labor cost variance, and its classifications are labor rate variance and labor efficiency variance. Same for the variable cost variance. It's subdivided into variable expenditure variance and variable efficiency variance. And now the most important, fixed overhead variance, which comprises of fixed overhead expenditure variance and fixed overhead volume variance, and that volume variance also subdivided into volume capacity variance and volume efficiency variance. Now we will consider each and every variance with some examples. First of all, it's sale price and sale volume variance. Sale price variance is said to be a difference of actual quantity sold at actual price and actual quantity sold at standard price. If the standard price is greater than actual price, then the variance would be negative. We have to sold at much higher price and we have sold at less price. That is why the difference is said to be adverse. That variance would be favorable if actual quantity sold at actual price is greater than the actual quantity sold at standard price. Favorable sale price variance can be caused by price increase due to improved quality, and adverse variance can be caused because of price cuts to increase sale. Sale volume variance. This is said to be a difference of actual quantity sold and budgeted quantity sold. And this difference, when we multiply with the standard margin, gives us a variance, sale volume variance. If actual quantity sold is greater than budgeted quantity, then the variance is said to be favorable variance. And in the contrary situation, if budgeted quantity is greater than the actual quantity, the variance is said to be adverse. Sale volume variance can be caused by price cutting or poor product quality. Here standard margin is standard profit in case of absorption costing system and standard contribution for marginal costing situation. For example, the standard selling price of a product is $10. Actual sales for 1000 unit at the rate of $10.5 per unit. Budgeted sales for 1100 unit and the standard full cost per unit of a product is $8. Here, to calculate the sale price variance, we have to identify the difference of actual and standard price. In this particular example, the standard price is $10 while the actual price at which the units are sold is $10.5. So because actual price is greater than the standard price, it gives a favorable variance. On one unit it is 0.5, and when multiplied by the 1000 actual quantity sold, it gives us the difference of 500 favorable. While sale volume variance can be computed by comparing the difference of actual quantity sold and budgeted quantity sold, actual quantity sold is less than the budgeted quantity, and this difference when multiplied by standard margin of $2 gives you a $200 adverse variance. Another example is given for the calculation of sale price variance and sale volume variance. Try to calculate sale price and volume variance, and if find any difficulty, ask in the comment section. In the cost variance, first variance is material price and usage variance. Material price variance is said to be a difference of actual quantity purchased at actual price and actual quantity purchased at standard price. In other words, what did cost and what should cost. The difference of what did cost and what should cost is said to be material price variance. As it is cost variance, so if the actual quantity purchased at standard price is greater than the actual quantity purchased at actual price, the difference is said to be favorable variance. It means when we have expectation of spending more and actually we have spent less for the purchase of actual quantity, the variance is said to be favorable. Reasons of this type of variances is wrong budgeting. Second, lower quality material or higher quality material is used than expectation than standard. Third is good or poor purchasing. And fourth is external factor like inflation and exchange rates. Second material variance is usage variance. It is basically difference of standard quantity that should be used for actual production and actual quantity that is used for actual production, and difference of this when multiplied with a standard price gives you usage variance and amount. First we have to consider what standard quantity is needed for actual production and what quantity we actually used. The difference of these two quantity gives you variance in quantity. Then you have to multiply this difference of quantity with standard price and you will get the difference in amount. First two reasons of this type of variances are the same, means wrong budgeting or use of lower or higher quality of material, but the next reason can be the use of lower or higher quality of labor. If you use lower quality of labor, there are greater chances that material will be waste more than expectation, and then this variance will be negative. And the last reason of variance is theft. Example, material M is used to make product A. 6 kg of material M at the rate of $6 per kg. The standard cost per unit would be $36. During a period, 500 units of A were produced using 3200 kg of material M, which cost $18,000. You have to calculate the material price variance and material usage variance. For the calculation of material price variance, the difference of standard price and actual price would be multiplied by the actual quantity purchased. Here actual quantity purchased is 3200 kg and the standard price per unit is $6 per kg. Actual quantity when multiplied with the standard price gives you the cost that should be incurred, and that comes as 3200 multiplied by $6 gives you 19,200, while the actual cost spent is $18,000 less than our standard, and it gives a positive or favorable variance of $1,200. For the calculation of material usage variance, we need to know how much standard quantity should be used for actual production. Here in question, we have produced 500 units and as per standard quantity 6 kg per unit, we should have used 3000 kg of material, but actually we use 3200 kg material. Actual quantity is more than standard quantity, that is why the variance is said to be adverse variance. But this is the variance in quantity. To calculate the variance in amount, we have to multiply this difference with the standard price and we will get the difference, we will get the variance in terms of amount. 200 unit multiplied by $6 gives you 1200 adverse variance. So in this example, material price variance is favorable, $1200, and material usage variance is adverse, $1200. If you have been asked to calculate the material total variance, you have to sum up these two variance, price variance and usage variance. Here price variance is 1200 favorable, positive, and usage variance is 1200 adverse, negative. So both variance negate each other and the total variance would be 0. Another example is given for your practice. The next cost variance is labor rate variance and efficiency variance. Labor rate variance is said to be a difference of actual hour at actual rate and actual hour at standard rate. Means what we should have to pay and what we paid. This variance can be favorable if we have more hours budgeted as standard and we have used less hours. Reason of this type of variance is again wrong budgeting, wage inflation, or lower or higher quality skilled employee used. And last one is unplanned overtime or bonuses. Variance is efficiency variance. This is said to be a difference of standard hours that should be used for actual production and actual hours that are used for actual production. If more standard hours are set and we have used actually less hours, then this variance is said to be favorable. The reasons of the variance is wrong budgeting again, lower or higher morale, lower or higher skilled employees, or lower or higher quality of material. The use of skilled employees or unskilled employees can create this efficiency variance. The use of high quality material and lower quality of material can create this difference. For example, for manufacturing of a certain product, product A needs a grade A labor. 2 hours of grade A labor at the rate of $6 per hour. Standard cost per unit would be $12. During a period 1000 units of product A were produced. Direct labor cost of grade A was $12,500 for 2100 hours of work. Requirement is the calculation of labor rate variance and labor efficiency variance. For the calculation of labor rate variance, we have to consider the actual hours worked, actual hour worked at the actual rate and actual hour worked at the standard rate. The difference of these two gives you labor rate variance. Here actual hours are 2100 hours that are used, and if used at standard rate, the total cost would be 12,600. But actually we spent 12,500, so the $100 variance is favorable, which means actual rate is less than our expected rate. For the calculation of labor efficiency variance, we have to consider how much standard hours are needed for actual production. Here actual production is 1000 unit, and as per standard 2 hours are needed for 1 unit of production. So 1000 unit needed 2000 hours, but actually we have used 2100 hours, more than our expectation. So it gives a negative variance in quantity, and when multiplied with the standard rate, it gives a negative variance in amount. Or you can say actual hour worked are longer than expected hour needed for 1000 unit of production. That is why this variance is said to be negative. To calculate the labor total variance, we have to sum up the labor rate variance and efficiency variance. In this particular example, labor rate variance is 100 favorable while the labor efficiency variance is 600 adverse. To sum up them, and we will get the labor total variance as 500 adverse. Next, cost variance is variable overhead expenditure variance and efficiency variance. It is the same like labor rate and labor efficiency variance. First, we will consider the variable expenditure variance, which is the difference of actual hour paid at actual rate and actual hour paid at standard rate. If standard rate is greater than actual rate, then the difference is said to be favorable. The reasons of this type of variance is wrong budgeting, wage inflation, use of high or lower quality of employees, and unplanned overtime and bonuses. Variable overhead are made up of many different overhead cost elements. To identify reasons for the variance, we could need to analyze all elements separately. Unexpected price change of overhead item and incorrect split between fixed and variable overhead is also a reason of these variances. Next variance is variable efficiency variance. It is again the difference of standard hours that should be used for actual production and actual hours used for actual production. If the standard hours are greater than the actual hours, this difference is said to be favorable. The reasons of this type of variance is again wrong budgeting, lower or higher morale, use of higher skill employees or lower skill employees, and use of higher quality of material and lower quality of material. For example, variable production overhead cost of product A is based on a standard of 2 hours at a rate of $1.5 per hour. The standard cost per unit is $3. During a period, 400 units of product A were made. The labor worked for 760 hours and the variable overhead cost was $1,230. Required is to calculate variable expenditure variance and variable efficiency variance. For the calculation of variable overhead expenditure variance, we need to consider what costs incurred if actual hours are paid at the standard rate and what is the actual cost that is paid. Here we have worked for 760 hours and these 760 hours, if paid at the standard rate, would cost you $1,160, but it actually costs you $1,230, more than you budgeted. So this variance is said to be negative or adverse variance. For the calculation of variable efficiency variance, we need to consider for the production of 400 units, how much hours are required. For 1 unit, 2 hours are required. So for the production of 400 units, we need 800 hours. But actually we use only 760 hours. So 40 hours are less used than our expectation. So this variance is favorable in quantity. Then this variance would be multiplied by the standard rate of $1.5 per unit and it gives a variance of $60 favorable. Again, for the calculation of variable total variance, we need to sum up the variable expenditure variance and variable overhead variance. Here expenditure variance is $90 adverse while the efficiency variance is $60 favorable. So it gives us a total figure of $30 adverse variance. Next, fixed overhead variance and mix and yield variance will be discussed in the next part of lecture. Do give your feedback and subscribe the channel. Thank you.